newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Francine Lacqua here in Paris. France's 10-year yields match Greece for the first time ever on rising concerns about stagflation and political uncertainty. The U.S. weighs more limits on semiconductor and AI chip sales to China, but stops short of stricter measures previously considered. Plus, U.S. regulators turned their focus on Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. So good morning, everyone. There's quite a lot going on this Thursday morning. Let's take a look at the European markets map. Happy Thanksgiving for those that celebrate, especially in the U.S. We're going to have thinner volumes across the board, but quite a lot of things going on in Europe. But European stocks actually snapping 2 days of declines. Again, technology leading the advance. There is hope that U.S. curbs on chip equipment sales to China may actually prove a little bit lighter than feared. A lot of the focus is what's happening in France. We're here in Paris, where yields on benchmark French bonds actually rising amid worries that a budget standoff may topple the government. I'm looking at the rate on the 10-year French note regarded as among the safest in the euro area, actually climbing a lot. The same comparable Greek bonds, which only last year were still classified as junk. A couple of other things we're watching out for. So again, because of Thanksgiving, a reminder that trading in treasuries is actually a shot. We look at the next couple of days with quite a lot of anxiety if you're a market participant on whether the Prime Minister in France can find a way through the budget. The French 10-year yield at 2.979. Now, the Biden administration is said to be weighing additional curbs on chip sales to China, a crackdown that stops short of some of the stricter measures previously considered. Well, let's bring in Bloomberg's Katya Dmitrieva. Katya, thank you for joining us. So why are they coming now?
Well, there's a limited time for the administration to get through a lot of these policies before changing hands, of course, on January 20th, when President-elect Donald Trump will come in. And the Biden administration has really made chips one of their hallmark issues during the entire presidency. Everything from protecting local industry with tariffs and supporting local industry with the CHIPS Act and IRA. And we can probably expect a lot more of these things to come in the coming, give or take 8-9 weeks that are left, including the Commerce Department, which still needs to give out a lot of support, a lot of subsidies. That's part of the CHIPS Act, the multi-billion-dollar package. They still need to provide funding for companies. So this is just sort of the first of many announcements we'll probably hear specific to this industry.
Katya, where does this leave China-U.S. relationship in the final weeks before Trump enters the White House?
Yeah, it's a great question. What I've noticed in the past couple of weeks in particular is that the Biden administration and Chinese officials have really worked to highlight places where they have common ground. And one of those issues being, of course, fentanyl and precursor chemicals coming from China, going to Mexico, making their way into the U.S. And so this sort of, if anything, serves to highlight how different the Biden administration is from the incoming Trump administration. They're both protectionist. They're both looking to do or have added tariffs onto goods. But it sort of highlights how different they are in their approach and how the Biden administration is a lot more targeted. For example, with these particular policies that could be coming as soon as next week, initially there were discussions of having about 6 Huawei suppliers, and now that's been whittled down. And there's also tariffs only on Chinese goods, as far as we know, not Japan and the Netherlands. They had been talking to Biden officials for the past few weeks on this particular issue. So it really narrows down the impact, which of course helps for business leaders and officials. But I guess I would say welcome to the next 4 years, which will be more of this.
Yeah, we'll have to figure out policies and, of course, the impact on everything from tariffs, inflation, and what the Fed does. Thank you for all of your insights, Katya Dmitrieva. Now, the Fed's preferred measure, of course, of underlying inflation accelerated in October from a year ago, supporting comments by many Fed officials that there's no need to rush interest rate cuts. Now, we're now joined by Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Grace, always great to speak to you. There's quite a lot of going on in terms of possible policy change in the U.S. We had quite a lot of data from the U.S. today, of course, thin volumes because of Thanksgiving, so happy Thanksgiving. But how do you see risk assets in the U.S. evolving?
Good morning. So great to be here. I mean, just referring back to the inflation print, the PCE print that you mentioned, there's no doubt that inflation risks are back on the agenda. I would say, that's flashing an amber light, not a red light to me, but we have seen signs not just in the rising 3-month trajectory of core PCE, but also with consumer inflation expectations rising. I would say, though, when we start to think, what does that mean for risk assets, that you can't take just inflation in isolation. This is about a growth inflation mix. And when we think about the growth trajectory that the next administration is going to inherit, it is very robust. We're seeing 2 to 2.5% US real GDP growth now, and that level could well continue through the next 6 months, perhaps even the balance of 2025. So we still feel the underlying US economy is pretty strong. But we have just published our 2025 outlook. We call that building on strength, because obviously we've had 2 years of strong risk asset gains, and therefore the underlying theme that we want to promote is the idea of strengthening portfolio resilience, i.e. aligning to a base case, but also managing for those tail risks that you mentioned, Francine, that include higher inflation, but also the idea that growth may weaken and will weaken at some point cyclically as we go through a business cycle.
Grace, what do we know about U.S. policy? I know, markets are quick on their feet to try and figure it out, but we still don't have, the Trump administration in place. So is the market getting a little bit ahead of itself? Could things change, or do you just expect a lot of volatility as we try and measure the impact of things that have been said?
Yes, I mean, this all feeds into the idea of what does a resilient portfolio really mean in the regime that we see today. The policies are still very unknown. We can start to guesstimate what that might mean for both that and the growth and inflation mix. And what it leads us to believe is in strengthening portfolio resilience, you want to still absolutely stay invested. As I mentioned before, we think there is a really solid outlook for growth over the next 12 months, but actually also over the medium term. But inflation risks are there. Geopolitical risks are there, risks around the deficit are definitely there, and therefore adding infrastructure, adding gold as two of our preferred ways to strengthen portfolio resilience we think is critically important. And then even when it comes to the equity book, making sure that you're broadening out your exposures, because the other underlying theme to us is capital investment, whether it be in the AI transition, whether it be in power and security needs, all of these is driving a broadening out of, we think, GDP trends, but critically also within equity markets. So go global, go broad, stay invested, but add insulation, we think, from infrastructure and gold.
Grace, do U.S. equities actually trump any other equity worldwide?
I think they still do. I mentioned that we do like to invest globally. What we're looking for there is really strong global leaders. So we don't want to bet on, the European economy, which we do think is fundamentally weaker at a headline basis, or Japan or any of the other regions. We want to just pick out really strong global companies. But we do think that US exceptionalism is likely to prevail in the period of time ahead. US earnings growth of around 11% in this year and next year, we think, with greater contribution, as I say, beyond just large cap tech. We think that's really appealing. And we would pay 21 times for that, which means that you're looking at a price target of around 6,400. So 10% upside for US equities. When that comes to European equities, we're probably looking at mid to low single digit returns with a high degree of uncertainty, as you flagged earlier, Francine, around the impact of potential policies, the timing, the magnitude of those policies. And I think even before we know, the risk premium over European assets is going to stay there. And therefore, the US is still our preferred market, whilst we like that global approach.
Grace, I'm here sitting in Paris, and actually there's a lot of concern that the government will fall, that Marine Le Pen will pull this kind of coalition over the budget. We're seeing spreads widen quite significantly. I mean, is there a lot of anxiousness in Europe that means that you want to move your portfolio away from France specifically?
We've been reducing our exposures to Europe more broadly on the equity side. And I think when it comes to the rates or the fixed income side as well, there's a two-way tussle between the growth inflation mix. Again, the concerns around European growth being so much weaker, and we've seen that from PMIs come through more recently, that actually argues for longer duration positions versus concerns over debt. It's a global theme. We talk a lot about it in the US, but as you say, it's definitely front of mind when it comes to France and the euro area more broadly at the moment as well, which argues for moving into private assets. But broadly, as I say, we are US biased, whilst we do see opportunities far more selectively when it comes to Europe and other regions as well.
But could this be the start of a real crisis in France and other countries?
I mean, we tend to look firstly at the fundamentals, and so we aren't in any way planning that this is going to be something that plays out into something more existential. We've seen events in the past, whether it be in the UK or even in the US with the debt downgrade that we saw some 18 months ago, that the term premium in the bond market can spark very quickly. You can see a very quick increase in the back-end rates. And so generally when we're thinking about fixed income positions, we are keeping positions to the short to intermediate part of the curve to try and guard against the situation that you're talking about having a negative impact to the returns that we can achieve for clients. Because what we want to extract out of fixed income is what is still a very attractive yield, more so in the US, but still very much in Europe. And so by sticking to the front end, or as I say, the intermediate part of the curve, we think that you can maximise the income and the carry whilst also minimising your exposure to back-end rates blowing out if there were to be periods of concern around deficits in particular.
Grace, thank you so much. Grace Peters there, Global Head of Investment Strategy at JP Morgan Private Bank. She stays with us, and we're looking at some of the European stocks. In fact, the political turmoil in France. I'm looking at the Bloomberg terminal, also weighing on the country's stocks. I think they're set for their worst underperformance against European peers since 2010. Coming up, we're we've had the latest regional CPI figures from Germany. The November reading for North Rhine-Westphalia rising some 1.9% year on year. So more on that next, and of course the macroeconomic pressures here in France. This is Bloomberg. Well, Germany's North Rhine-Westphalia November CPI rising some 1.9% year on year, falling 0.3% month on month. For more, let's bring in Bloomberg's Jana Randau, who's in Frankfurt. Jana, great to speak to you. When you look at the German figures, I mean, it's just so hard to catch a break and have some good indications of where Germany goes next.
Yeah, so the key there is to look at the monthly change at the states report. So that is down 0.2 or 0.3 on the month, and that is roughly in line with what's expected for the country as a whole. And of course, then if you look at the corresponding expectations for the annual figure, that would probably mean an acceleration of inflation in November to about 2.3%. Not what you want to see if you're the ECB, but at the same time, that acceleration comes very much expected. Policymakers, including President Christine Lagarde, have warned that it's going to be a bumpy road back to 2%. So yes, an acceleration in Germany, the region's largest economy, of course, in November. A similar move expected for the Eurozone as well, but nothing that policymakers will be stressed about in too much of a way.
Jana, France CPI comes tomorrow with stagflation fears, and of course this political turmoil that we're watching on a minute-by-minute basis from Paris. How bleak is this for France, or are the worries overstated?
Yeah, I mean, we're going to see a similar pickup in inflation in France, if you can believe the forecasts. The overall trend is slightly lower there. And yes, of course, you're right. The French economy really has sent rather bleak signals. When you look at the latest PMI readings, they are firmly in contractionary territory, and not just in manufacturing, but also in services. And that, I think, was a big surprise, how weak services were in France, or currently are. You look at business confidence, you look at consumer confidence, all that was well below expectations in the latest reading. So there is a lot of uncertainty in France, and of course, I don't need to tell you, the government was stable, was very fragile from the beginning, and that budget fight isn't helping confidence on any level. And the fact that the finance minister, that Armand, is now signaling openness or readiness to make some concessions on the budget, that should be helpful. But of course, it remains to be seen whether he will succeed, whether they will be able to agree. And if you look at the market is taking a pessimistic view. We have 10-year yields, at the same level as Greece for the very first time ever. So that is not very helpful. A lot of uncertainty means consumers are staying home. It means investment isn't happening. So yeah, it's a serious situation.
Jana, thank you so much. Jana Hando there with the very latest, of course, on France. I have to say, we're broadcasting from Paris today, and you can hear people talking about it in the street. There is a little bit of anxiety, or certainly a lot of focus on what happens next. So let's get more thoughts from Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Grace, when you look at, again, we were talking a little bit about, the fact that you don't see any real crisis or contagion fear from France. But would the ECB have to step in? The ECB is already going through a tough time if they have to deal with Trump and the Trump tariffs.
Yes, and I'm going to bring it back to the growth inflation mix. We said for the US, let's not worry too much about inflation, because if you've got 2.5% real growth, 2.5% core inflation, that's 5% nominal. That's actually a pretty good situation. That's a win. The same is not the same for Europe. We've got the same trends around inflation, the notion that some of the disinflationary trends bottomed out over the summer months, and you're seeing stickiness in core. But the growth side of the inflation in the Eurozone is just not anywhere close to 2.5% real. We're looking more, 0.5 to 1%. And so the growth inflation mix is far weaker in Europe. And as you say, there's also the potential for tariffs to come next year. So I do think this leaves the ECB on a very different path to the Fed. We're expecting far more cuts from the ECB, potentially cuts of 50 basis points in size. I do think the overall mantra is going to be to not panic. They want to wait for the data. They want to show a steady hand. But undoubtedly, I think the ECB will continue cutting rates through the balance of this year and at a faster pace next year. We still don't know where the neutral rate is, whether it be for Europe or the US. This is obviously always an arbitrary figure, but it certainly feels that the neutral rate in the US is higher, and therefore there will be a shallower cutting path when it comes to the Fed versus the ECB.
Grace, thank you so much. Grace Peters, there, Global Head of Investment Strategy at JP Morgan Private Bank, joining us this morning on a big markets day. Now, coming up, the U.S. Federal Trade Commission zeroes in on Microsoft with a wide-ranging investigation. So we'll have the details of our Bloomberg scoop next, and this is Bloomberg. Now, the U.S. FTC is investigating Microsoft. We're told that the Federal Trade Commission is looking into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Now, let's get more on our Bloomberg scoop with Bloomberg's Peter Elstrom. Peter, great to have you. So just how widespread is this inquiry?
This is quite widespread at this point. We're seeing a number of these activities come out of the Biden administration now in the closing weeks of the administration. Lina Khan has been particularly aggressive on some of the big tech companies. We've seen that in a number of different areas beyond Microsoft. But in this particular case, what we found out, again, this is a Bloomberg exclusive, we found out that the FTC is looking into how Microsoft is handling a number of its different businesses and tying them together. That includes the cloud computing services that so many corporations buy, so many consumers use, artificial intelligence and cybersecurity in particular. What we've heard is that some of these cybersecurity breaches that we've gotten over the past year or two have raised some concerns in Washington about how Microsoft is packaging these issues. Now, Microsoft, of course, was under antitrust investigation more than 20 years ago. That was for how it was tying its Windows operating system into other products, particularly its web browser, and keeping Netscape out of the web browser market as much as it could. In this case, it's much broader than that. Microsoft was powerful then, but it's even more powerful right now. It does have a leading position in cybersecurity. In particular, that's one of the areas where they have customers, including the U.S. government, and they're a bit concerned about how all these pieces are fitting together and whether Microsoft is using that kind of market power to keep out competition and perhaps to have some of these services that are vulnerable to breaches, like we saw with these cybersecurity incidents in the past. So that's going to be a concern. The question is whether the Trump administration is going to continue this effort.
Yeah. Peter, thank you so much for all, of course, this extraordinary scoop and, of course, the explanation that goes with it. Peter Elstrom. Coming up, France's benchmark bond yields matches Greece's for the first time on record. So we take a look at how political uncertainty is roiling French assets. That comes next from Paris. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris, and these are your top stories. France's 10-year yield matches Greece for the first time ever on rising concerns about stagflation and political uncertainty. The U.S. weighs more limits on semiconductor and AI chip sales to China, but stops short of stricter measures previously considered. Plus, U.S. regulators turn their focus on Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. Now, earlier this morning, France's benchmark bond yield matched Greece's for the first time on record, putting the bloc's second largest economy on an equal footing with a country once at the heart of the European sovereign debt crisis. Now, this comes amid ongoing concerns over French government's viability. So let's get more from Bloomberg's Valerie Teitel. Valerie, what are you looking at in the markets?
Look, we are seeing a bounce when it comes to French assets on the headlines that the government could give some more concessions to pass this budget. The CAC 40 is outperforming across Europe today. It's up 0.8%. We're also seeing French 10-year yields decline somewhat. They did surpass those of Greece, but we're still seeing a rally on the day, which is positive, I think, for the outlook. Eurodollar, though, is maintaining its weakness. It's down 0.3%. But I want to flip on and talk about European banks, Francine, because they're also rebounding slightly when it comes to France. BNP Paribas, Crédit Agricole, and SocGen, the biggest three French banks, all in the green, unwinding some of the weakness that they have seen over the last week. But if we want to talk about pessimism, we have to look on a long-term picture. If you flip on and look at my next chart, the CAC 40 has underperformed by a very wide margin the broader European benchmarks, the DAX and the Stock 600. This margin of underperformance, Francine, is actually the second largest that we've ever seen since the creation of the euro. So it is quite a pessimistic sentiment out there. We're going to have to do a lot to unwind that if we do get this budget passed in the next month or so. While I'm on that, I also want to talk about maybe the pessimism when it does come to those bond yields in France. If we take a look at how they have compared to Greece, that French 10-year traded inside that Greece 10-year bond or just earlier this morning. Very funny to note that, Francine, especially because during the worst of the sovereign debt crisis, the Greek 10-year yield traded 3,000 basis points above the analogous French 10-year yield.
Yeah, I mean, to be fair, Greece has actually done so much that maybe they'll look at our screens and look at markets, chatter and think that's a little bit unfair. But certainly it does show all of the anxiousness that there is with France right now. Valerie, thanks so much. Valerie Teitel. Now, for more on the political standoff in France over the country's budget, let's bring in Famke Krumbmuller, Executive Director of Geostrategic Business Group at EY. Famke, thank you for joining us. Through the years, you've always been brilliant at explaining some of the political turmoil that especially France has gone through. This feels different because a lot more is at stake. Marine Le Pen has basically threatened to pull out of the coalition, to pull out of the government and go to fresh elections. Can they find a compromise? Or do we go to elections early January or February?
Hi, Francine. So, first of all, to answer your last question, they cannot go to elections in early January or February because the Constitution says that you can only dissolve the parliament once a year or every 12 months, meaning earliest elections can only be held next summer. That also means that I do believe the actual benefits of making this government fall are limited for everybody involved, because we would still end up with the same composition of the French parliament. That being said, in my view, what is happening right now is that Marine Le Pen of the Front National, she is posturing. I'm not sure she has actually decided how she will vote, but she's clearly trying to get concessions out of the government in order to not vote against them when the budgets, because it's 3 votes in Parliament, go to Parliament throughout December.
So, Famke, first of all, if Marine Le Pen pulls out and they can't go to election, what happens? Are they deadlocked then for 7 months?
Well, we go back to square one where we were this summer, which is the president needs to appoint a new prime minister. He could reappoint Barnier, he could appoint somebody else. But because the composition of the parliament hasn't changed, there will be the same struggle in terms of finding majorities. The alternative would be to go for a technocratic government. I think that is currently rather unlikely. It's something that we've not seen in France before. I think would not fit the political culture. But so more deadlock, more lost months in a context where, of course, there's urgent need to reduce the French deficit.
Famke, at this point, what is Marine Le Pen? I mean, she's really the kingpin, right? She's trying to get things. What does she need from the current finance minister and the current prime minister to keep her, happy enough for the budget to go through?
Yeah, so I think, first of all, what is important to understand is that her fundamental political dilemma in terms of voting or not voting against the government right now is that on the one hand, she's trying to cater to her base electorate, which is the electorate that is against this budget, against the government, that has been with her for a long time. And on the other hand, she's really trying to broaden the electorate by capturing new voters that actually she's trying to prove to that she's a responsible politician and that she can be in power, of course, eyeing the presidency. That's her dilemma, I think, very important to understand. Now, if the government wants her to be able, let's say, in front of her electorate, to not vote against them, they will need to give her something that she can use politically. She's, in my view, made it quite clear what this could be. And it could, for example, be around the electricity tax, which is something that the economy minister mentioned already this morning.
How much, Famke, does that, I mean, again, it's always a money problem. So how much of a hole in the budget would that bring? Is there, if you do concessions, and again, we're looking at a lot of the French press, the French commentary, and there does seem some negotiation room. Is there a concern that actually the numbers don't add up, and so the EU will have to get involved?
I mean, there's always a concern that the numbers don't add up. And of course, that is in the nature of the concessions right now. I think what now will have to be negotiated is what is the alternative? The alternative is a continuation of last year's budget if this doesn't go through, which of course does not have the same provision as this one. And at the same time, the government can try and find other things to make up for that concession that they will maybe give to Marine Le Pen. Outside of the budget, though, they do have other opportunities as well. Things that she has mentioned that are important to her are, for example, on the immigration law or on things like electoral reform. That is something that would be outside of the budgetary debate, but would also be a signal towards her party. All of that being said, of course, at the same time, the government does not want to be seen to be too close and too dependent on Marine Le Pen's approval of what they're doing, and this is the dilemma on their side.
Famke, it's pretty incredible, actually, having followed, the career of Marine Le Pen, how she's kind of changed at the margins, being more business friendly. Just 6-7 years ago, she was quite anti-Europe. Now she seems to be, put that to rest because it's not really playing out with the electorate. It's very clear that investors today are steering clear of some of the French assets after this flare-up. Would she be worried by that? Is it something that she cares more than 5, 6, 7 years ago?
I would definitely think so, especially for the reason that I explained before, which is the fact that she's trying to attract a broader, newer electorate that would allow her to get to majority in a potential presidential election. And this electorate is actually an electorate that, as I mentioned, cares about stability, but also cares about, for example, the attractiveness of France, the business environment, and the instability. We've run a survey at EY on France's attractiveness for foreign investors, and 50%, almost 50% said that they have actually delayed or stopped further investments into France, given the current uncertainty. And so this is something that matters also to part of her electorate, actually.
Famke, thanks so much. Famke Krumbmuller there from EY's Geostrategic Business Group. Now, Rémy Cointreau dropped as much as 5% after it forecast a larger than expected drop in annual sales. Now, the cognac maker says it expects organic sales to fall by up to 18%. The firm also adds it does not expect a recovery in U.S. markets until at least the end of the year. Unlike rivals, Rémy has resisted lowering prices to protect its margins. Now, coming up, the UK government backs down from its EV sales mandate as the threat of US tariffs looms over the economy. More on that story next, and this is Bloomberg.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning.
Well, that was Nouriel Roubini, the chairman of and CEO of Roubini Macro Associates. Now, the UK government has vowed more support for the nation's car industry and will consult with manufacturers and changing an electric vehicle sales mandate that they will not meet this year. Let's get more from Bloomberg's Craig Trudell. So, Craig, thank you for joining us. How have EV sales actually been faring in the UK?
They can sort of be deceiving because they're actually doing okay, but the problem is that they're not doing as well as the government is trying to mandate. And the only reason that they're doing okay is, if you believe the manufacturers, is that they're discounting like crazy. The industry's trade group estimates that the level of discounting of EVs will be somewhere around £4 billion this year, which is quite a big sum and something that they, for sort of understandable reasons, say is not sustainable. And when you look at the whole industry and the share of sales that are battery electric vehicles, you have to take into account that some of those manufacturers are only selling EVs, Tesla, for example. And so that inflates the industry number, and this is a regulation that's manufacturer by manufacturer. So there are a lot of companies that are nowhere close to meeting the 22% share that the government has tried to mandate for this year. And those figures only go up between now and 2035.
So, Craig, UK car output, I think, dropped around 15% in October, and that marks the 8th consecutive month of decline. Put that into context for us. Could the decline even strengthen further?
Yeah, I think the outlook for next year is not good. You have an industry that is putting a lot of investment into trying to make this switch over from petrol and diesel cars here to making electric vehicles that, when you look at the domestic market, the amount of government support and incentives has been pulled back over the last few years. That's part of, what we're hearing from the government is when they say that we'll offer more support, I think there's going to be some rethinking of those incentives that have been pulled back. The industry would like to see, for example, a lower value-added tax on new electric vehicle sales so that more consumers are buying them. Because what we're seeing is a lot of purchases of EVs is actually through salary sacrifice schemes or company cars. And so the sort of lay consumer in the UK, or the typical consumer in the UK, just isn't buying, and that has to change for these plants to be able to sort of have the demand that is commensurate with the capacity they're putting in. And we also have to think too, I mean, the export markets, much of Europe is having a lot of the same issues of incentives being taken away and the momentum having left the industry as a result of that.
Craig, what does Donald Trump actually mean for EVs in Europe and the US? We could look at extra tariffs. He's not probably the most climate-friendly president the US will have, but he also has Elon Musk as a sidekick.
Yeah, I think when that may actually be one source of optimism. When you look at the numbers that were reported overnight, about the production figures, there was a big bump in exports to the U.S. and I don't know whether that is sort of some preemptive moving by manufacturers to kind of get as many cars sent to the U.S. Before any potential tariffs. We've not heard Trump single out the UK. He's at least to this point only threatened Mexico, Canada, and China. It may only be a matter of time before he does the same with the UK and Europe, because we know that he's not particularly happy about the fact that in his words he sees Mercedes-Benzes all over Fifth Avenue, and you don't see Cadillacs or Lincoln in Berlin, say. And so I do think that that is absolutely a concern, that on top of all of these regulations, on top of the challenges that companies are having with selling EVs, there are real worries that these trade measures will only make their lives more difficult when Trump is in office.
Craig, thank you so much. Craig Trudell there with the very latest on cars, EVs, and of course the Trump administration. Coming up, Ukraine faces tough choices as fears grow of the U.S. pulling support from its war against Russia. We'll look at Kyiv's options next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in Paris. Now, countries in the Nordic region have long been among the most vocal about the threat of war on their doorstep. Now, Finland has launched a website showing people how to prepare for any type of crisis, including how to last 72 hours in the event of a conflict or other crisis. While neighboring Sweden has begun mailing updated leaflets to households urging a greater emphasis on preparing for war. So let's get more from Bloomberg's Nordic managing editor Kari Pajapalo. Kari, why are European countries now stepping up this preparedness?
Hi, Francine. Russia's war in Ukraine has really hit it home for Europeans that war is not something that exists in history books. It's something that can happen here as well. And given the primary job of governments is to keep their people safe, a lot of European governments have sort of woken up and started preparing now. There's also awareness that climate change will bring on a lot more extreme weather events, like the floods you saw in Spain very recently. And we've just come out of a pandemic a few years ago that was global. So there are a lot of threats that people are starting to consider.
So, Kari, what's happening in different countries, and what's the EU's role in this?
You already mentioned that Finland's set up a new website to give guidance to people on how to deal with various crises. Sweden's mailing leaflets to people, but there are also other things being done. Lithuania is stockpiling medicines as part of a big European Union effort to put in medical stockpiles in 22 stockpiles in 16 European Union countries. And then in Denmark, they're thinking about a scenario in which the financial sector would need to kind of take care of people in case a power outage lasted even as long as a week. Like, how would you pay for your groceries? And what they're doing is they're making sure that all debit cards will continue to work throughout that entire week, because people have so largely moved away from cash now. And then Norway and Sweden are among countries that are thinking about bringing back grain stockpiling, that in a lot of countries in Central Europe, in Finland, they just always continue to do that.
So, Kati, tell us, why is Finland actually seen as a blueprint for other countries in terms of preparedness?
Well, Finland has always felt that there's a threat on its doorstep. There is a very, very long border with Russia, but the country has also experienced famines. And it is just 100 years ago that people were still baking tree bark into bread to survive. Finland is surrounded by sea on all of the sides where its main trade partners lie. So it's very hard to bring in supplies during a crisis. And that's why preparedness has been something that the country's been doing for almost 100 years. Since the 1950s, they really started organizing that. And because it's been going on for generations, it's become this thing that people just do. It's part of the mental awareness, the psyche of the country.
So, Kati, can you talk to us about the relationship? I mean, what kind of relationship do the leaders in Finland have with Russia right now? It's been, frankly, a war that's shocked many. Is there still some kind of diplomatic relationship?
No, there's not on the political level. There is a long border, and border authorities do naturally have contacts with their counterparts on the Russian side. You have to, on the practical matters. There is a canal, Saimaa Canal, that half of it goes in Russia. That is the only kind of navigation route into Finland's Lake District from the Baltic Sea. And there's cooperation on that front as well. But really, it's only just the daily practical matters. There is no political relationship and no contact.
Okay, thank you so much. Our Nordic managing editor there, Kati Pohjanpalo, of course, leading a fantastic team, breaking a lot of news and giving us a lot of great Bloomberg stories that you can also find on the Bloomberg website. Now to some other stories making news. France's richest man, Bernard Arnault, is set to testify in a criminal court today. Now, the LVMH chief executive says he is completely unaware someone was trying to blackmail him. The case actually centers around one of the billionaire's former bodyguards, Anna Paparazzo, who allegedly demanded 300,000 euros in exchange for photos of him with a woman who was not his wife. Direct Line Insurance has rejected Aviva's £3.3 billion takeover bid, saying it substantially undervalues the business. Well, under UK takeover rules, Aviva has until December 25th to announce a firm intention to make an offer or walk away. Now, it's a second takeover bid rejected by Direct Line this year, following a proposal from Belgian rival Ageas in March. And Enka Group, the largest IKEA franchise, saw a sharp decline in full-year profit after a round of price cuts and tough economic conditions weighed on the bottom line. Now, the Swedish furniture seller reported a 37.5% decline in operating profit to 1.3 billion euros for the financial year through August. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York. We'll have a full roundup of everything that's happening, of course, in France. Happy Thanksgiving to those celebrating in the US. This is Bloomberg.